It's time for your personal bank show with Ferenc Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a bank in formation. Take charge of your financial future with your personal bank. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. I'm really excited because we're really sharing this idea with a new audience and expanding our audience. I've been sharing this idea actually for 7 or 8 years now. I've actually been speaking, like I said, to a number of investor groups around the country. I've been on the radio for the last couple of years, and now we just have a new audience. That's pretty exciting. The question I get all the time, I shared this if you heard yesterday on our show, is how does it work? What is your personal bank? And really what your personal bank is, it's really quite simple. We do two things. First step is we set up a high cash value policy that's established to maximize tax-favored cash growth. We want to grow our money, and we want to grow it income tax-free. Okay? Second step is we want to set up a bank line of credit. We use the cash in the policy as collateral for the bank line. These are super easy loans to get. The applications are super easy. Again, it's a collateralized loan. And getting approved is the easiest loan you probably ever got approved for. Unless you have judgments or liens, basically you'll get an approval. And the key point here is simple. We're trying to create positive arbitrage. What is positive arbitrage? You're earning more than you're getting charged. We have companies, like I said, these are not the type of insurance policies most people are familiar with. We have companies that have been paying 6% dividends even today, and have for the past 25 years plus. Never missed a dividend, some of them since before the Civil War, literally. And the bank lines of credit are in the 3 to 3.95 range, depending on the amount of funds we're dealing with. So when you access the funds through the bank line of credit, you're getting credit in the 6 range, you're getting charged in the 3 range to use the funds. What's your money doing? You're keeping the difference. You're still making money on money you spent or allocated elsewhere. And folks, if you heard me, like I said previously, or heard me in previous shows or anything else, that is the power. That is the game changer. You can earn interest on money you spent. The key point of all this is real simple. Where else can you do that? That's the big question. I've never had anybody give me a response to a different option. So this is the way to make money on money you spent. Now, if you're earning interest on money you spend, by the way, it's not just this year. If you spend some funds this year and you use this tool and you pick up 2 or 3% positive arbitrage interest, you keep the difference on some money this year, what happens next year? You still earn interest on that money next year, and the year after that, and the year after that, frankly, every year, the rest of your life. In a decade or 2 or 3, what kind of difference can that make? And if you understand compound interest, you understand that difference can be huge. Okay? That is the true power of your personal bank. Okay? The thing I want folks to understand, and I want you to, the key that I run into and the questions I get all the time when I first introduce this idea to people is like, wow, that's interesting. I get a lot of very positive responses when I first introduce the idea, okay? First thing I probably get is, wow, I had no idea there was companies paying 6% dividends in today's low interest rate environment. And the answer is yes, they are. In fact, there's a chart I can show you. Be happy to do so. If you contact us at yourpersonalbank.com, I'll be happy to send you that chart. Or if you want to chat about your situation, I'll be happy to do so. By the way, folks, if you just have a question, you're just like, this is interesting. I have a question I'd like answered. I'll answer it over the air. I do that all the time. Many of our clients, great examples I run into. I'll be talking to a client or a new client, and they'll say, "Hey, I listened to your show last week, and I had to laugh because I knew you were talking about my situation." And I'm like, "Yeah, I sure was." Now, of course, I won't share any names, so nobody knows exactly. Can't refer back to anybody in particular, but they get a kick out of seeing or hearing their situation, their case being shared with others. Because, look, if it works for this person in this scenario, there's many others that have a similar scenario, don't they? And it just shows how your personal bank can enhance your financial future. You can earn more money. You can keep more money so you can supplement retirement or have more to live on throughout your lifetime. you can reduce your taxes, your overall tax liability. That's a good thing. And again, I think with what we're headed for politically, again, most people think with the new administrative changes we're going to have soon that taxes are probably going to go up. So does it make sense to have some money in a tax-free environment? Well, it makes more sense than ever if that's the case, right? And having some guarantees, having some consistency, having your money grow on a regular basis every year, at least a portion of your money doing that with some underlying guarantees, okay? That's with uncertainty, that becomes more powerful. It's always talked about, it's always said, the market abhors uncertainty. I think from a political standpoint, at least, and an economic standpoint, 2020 should have taught us some lessons. And going into 21, we have a lot of uncertainty in terms of what the economy looks like, what small business is going to look like going forward. Hey folks, I have a real concern. I'm an entrepreneur myself. I'm a small business owner. I have seen a devastation of the small business community unlike I've seen in my lifetime, maybe ever. And if in fact it's true that estimates are somewhere of upwards of half the small businesses that existed prior to COVID will not be around after COVID, once all these shutdowns are over and all this other stuff. You know, studies have shown over and over and over again that about half of employment in the United States, about half the jobs in the United States are for what small business provides. Now, if half the small business is gone, that means about a quarter of the jobs that were around prior to COVID won't be after. What's that going to do to unemployment? What's that going to do to our economy? I understand recently the stock market has been doing well. Frankly, it's been a huge dichotomy in terms of what the economy's been doing versus what the stock market is doing. Is that a long-term thing? Is that going to continue? Is there going to be volatility in the future, uncertainty in the future? You know, if we get more government regulations, is that going to impact business? Is that going to impact our economy? All of these things come into play. And it's kind of funny. I was, like I said, I've been on the radio for a couple of years now. And I started as a financial show. And when COVID came about, particularly when the shutdowns, particularly when that came about, I started talking more about politics more than I ever have in the past. And the reason behind that is really quite simple. The political situation, the shutdowns in particular, were directly impacting our economy. You shut down business, that's the engine of our economy, right? So it had direct relationships to money, business, what's going to happen, right? So probably the first and most common reason why radio listeners particularly contact me, like I said, again, encourage you to do that, yourpersonalbank.com, is they look at it as a diversification tool. And it's a diversification tool. It's a non-correlated asset, okay? Now, I've had shows on this. In fact, I've had entire shows that I've talked about what is a non-correlated asset. How do you define that? The short version is basically you have an asset that's not directly, the value of that asset and its returns is not affected by the same factors as a different asset. Okay. So in other words, if you have market investments in the stock market, for example, and you have something outside of the stock market, what affects the value of that asset in the market is totally different than the value of this asset. That's called a non-correlated asset. Having some of that, having your money in different buckets, with some guarantees, non-correlated, just makes a lot of sense. That's the basis of diversification, by the way. I've even talked about how Wall Street, we'll say, has, in my opinion, bastardized the term diversification. Diversification used to mean you had some money in the market, you had some real estate, maybe you had some precious metals, maybe, various different things. Today when you say diversification, most people think of, well, I have my money in different sectors, but they're all in the market still. And when you have major events occur, like we saw in March of 2020, when COVID first hit, We saw a huge stock market. We saw a 30% drop in 30 days. We saw a massive recovery quickly after that. I think, if most people are honest, they didn't expect either. They didn't expect the massive drop. They didn't expect the massive recovery, and certainly not as quickly as it occurred. What's going to happen in the future? That volatility that's there. Again, the market abhors a vacuum. Now, by the way, if you're sitting there thinking, what is your personal bank? Well, I shared very brief a little bit about what it is, and you want to know more about it. Well, I'm going to encourage you to go to yourpersonalbank.com. We have the show we did, the last show we did, where I really explained how your personal bank works. I'm going to encourage you to go to that, listen to it, share it with others. If you have somebody you think might benefit from this idea of how you can earn interest on money you spend, how you can reduce market risk, how you can reduce your taxes, how you can increase your liquidity, and, more importantly, how you can gain control back of your money. Folks, today, more than ever, that's a very valuable thing. I mean, some of these assets that are out there are exploding, like the cryptocurrencies and stuff, mainly because of the control factor. Who's in control of those dollars? With a personal bank policy, it's a contract. It doesn't fall under the federal guidelines in terms of IRAs and 401ks and all that kind of stuff that a lot of people have their money invested in and are subject to the whims and the tax law changes of whoever happens to be in charge of Congress, for example. See, we're not subject to all that. So you gain a large measure of control of your money back. That is hugely important. And again, I think that's hugely important, particularly today, more than ever. Okay? So if you want to learn more about how this works, again, go to yourpersonalbank.com, listen to the previous show, contact us for additional information. I'll be happy to talk to you, share with you how this works, what it can do for you. And I'm also going to encourage you to stay tuned in the next segment, because really what I want to start doing is sharing a little bit more of what we see going forward, what's going to happen, and particularly what's going to happen with your money and how you can navigate the uncertainty or the uncertainties that we see going forward. I don't know what's going to happen. I don't think anyone does. That's the problem. So you have to be prepared for all contingencies. One of the things I teach people all the time when I work with them, and I've been doing this for over 20 years, and that is plan for the worst and hope for the best. And therefore, if the worst happens, you can handle it. So stay tuned in the next segment, because I'm going to encourage you, don't miss it. It's going to be worth it.
For more information on Your Personal Bank, feel free to contact Ferenc at yourpersonalbank.com. Back to Your Personal Bank Show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. And of course, we've been talking about how does your personal bank work? And well, what are the typical uses for it and that type of thing? Again, what is your personal bank? A high cash value policy is established to maximize tax-favored growth. We want to grow our money. We want to grow it consistently. We want to grow it safely. And we want to grow it tax-free. The next step is we set up a bank line of credit. And the cash in the policy is used as collateral for the bank line. These are super easy lines to qualify for. Again, it's a fully collateralized loan. The key is the interest rate on the loan is lower than what you're earning. You keep the difference. Today's rates we're looking at in the roughly 6% range. We have companies that have been paying 6% dividends for the last 25 years plus. I'll show you the chart. You contact us at yourpersonalbank.com, and I will show you the charts of how much these companies have been paying for the last 25 years. It becomes immediately obvious who you want to work with. And again, this is not insurance like most people are familiar with as terms of death benefit protection. This is the type of contract policy that's designed to grow cash and grow cash safely with guarantees and tax-free, okay? And by the way, some of these companies have been paying dividends since before the Civil War, literally. There's a lot of people concerned about risk and uncertainty and things like that. I'm not aware of anything else out there from a financial standpoint, a financial tool that has a longer or stronger long-term track record. There just isn't one. And at times of uncertainty, you want something that's been through a civil war. and been through the Great Depression and other times of great uncertainty and unrest, because that's the type of thing that's going to last through the next whatever happens, right? So that's what I'm trying to say. The second piece, again, is a bank line of credit. Super easy to qualify for. You're getting charged less than you're earning. The difference is if you're earning around 6, and you're getting credited around 6, and you're getting charged around 3, and you access the money, what's your money doing? It's still growing. Okay? You're keeping the difference, and that's positive arbitrage. And remember, never, 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 never forget that you're earning interest on money you spent. That positive arbitrage is coming off money you actually used elsewhere. You can't do that any other way that I'm aware of, and that changes financial futures in a big way. Now, one of the questions I get all the time is, why do you use the insurance tool? We could use a lot of different financial tools in this concept because, again, really all we're trying to do is accomplish is this. We want to earn more than we're getting charged when we use the money, right? We want to keep that positive arbitrage. That's the key. Well, we use these specific type of policies for a reason. One, we want compound interest. We want money to grow every year. Well, when we look at that kind of takes a lot of assets and investments off the table, right? Because they can vary in what they do year to year. We don't want any risk of loss. You really don't want to borrow against an asset that can lose value. A great example we saw of that was in 08-09 through the Great Recession. There were a lot of people that took money from their homes, took lines of credit from their property. The property values dropped below what the amount they owed, and suddenly they're underwater, right? That type of thing can really get you in trouble. So again, you want to have an asset that has no risk of loss. It has guarantees. It's not going to go backwards, particularly if you're going to use it as collateral for a loan. That's why we use this type of financial tool, the insurance tool. We want to have access to funds. We want to have 50 to 90% liquidity day one. That's another one of those things that people don't realize a lot of the time is, there's other assets out there, CDs, for example, some annuities that have the safety and guarantees built in, but they don't have anywhere near the liquidity. Most annuities only allow 10% a year, for example. CDs, typically, if you have a 1-year CD, you can only actually access the money once each year after the maturity date, right? Plus, CDs these days, interest rates are they're terrible. They're in the floor, okay? Annuities can have some better rates these days and decent ones. We deal with those when it makes sense. But again, they don't have the liquidity, so they're off the table. And then we want to have income tax-free growth access into the air and to the heirs. So when you look at the whole picture and the whole financial world, there's really only one financial tool that satisfies all these requirements or gives us these benefits. Now, there's another thing that I get asked about all the time is, well, what type of policy are we talking about? There's a couple different options. One is a fixed. It's your steady, Eddie, consistent, fixed one that I've referred to that, up to 6% dividends, been paying that for the last 25 years. By the way, many of those have a 4% contract guarantee. It means they're going to never pay less than 4. They've never, ever paid less than anywhere near that in the last 100 plus years, but they have that contract guarantee, which is nice. The other option is an index option. Now, this one's become more popular in recent years because of the stock market and what it's done, although more recently, less so popular because, well, let's face it, the markets are at or near all-time highs. And do you want to buy into a stock market or buy into any asset for that matter when it's at historical or near historical highs? The number one rule of investing, or one of them, is buy low, sell high, right? So it doesn't make a lot of sense, but this can be an option that still makes sense for some people even today. The key is with the index option is your returns are principal guaranteed, which means if the market, it's based on the S&P 500 typically, or other indexes like that, with principal guarantees, which means if the markets go down, you don't lose. So that's a nice thing. That's a positive. There's no downside market risk. You can get double-digit returns on good years with no downside. And we have some of these products who have an average of over 8%, historical average over the last 25 years without any downside market risk and income tax-free. When you consider an 8% return, a tax-free return versus taxable, Well, the difference can be significant. It could easily take a 10% taxable return or more to equal an 8% tax-free return. So you always have to keep that in consideration. So we can do both. One of my pet peeves in the industry is I run into this all the time. You know, some people, they're all about the fixed option and others are all about the index option. They love one and hate the other. And my response and comment to those folks is really simple. It's not about you. It's about the client. What is in the best interest of the client? What's most important for them? It's not about your preferences. It's about their needs and preferences. So the reality is we look at both. Many times we run numbers and illustrations and various things for both options when we're introducing this idea or running numbers for somebody, because we want them to consider and look at both options, both the pluses and minuses of both options. And from that, decide what makes sense for them. Now, here's the last piece of that. And this is where sometimes I kind of blow people's minds. It kind of goes poof. When they're trying to decide, well, I don't know if I should do this, the index option, should I do the fixed option? Should I do the steady Eddie? Should I do the index has more potential upside, but could have some flat years? And my response is, well, let's do some of both. Nobody ever said you had to do all one or all of the other. You can actually do some of both. And in some situations, that's what makes the most sense. So again, contact us at yourpersonalbank.com. Be happy to talk to you about this. I'll be happy to answer any questions. I'll even answer questions on the air for you. But stay tuned in the next segment. We're going to go into further about how all this works, so stay tuned.
For more information on Your Personal Bank, feel free to contact Ferenc at yourpersonalbank.com. Back to Your Personal Bank Show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. Again, we're talking about how Your Personal Bank works today. That's the number one question I always get. And as I've stated in the previous segments, it's really simple. We set up a high cash value policy designed to maximize cash growth, minimize taxes. We can grow money income tax-free. You can access it tax-free. You can pass it on to your heirs tax-free. We have companies that have been paying 6% dividends. Even today, been paying that over the last 25 plus years. And some of them have not missed a dividend since literally before the Civil War. So again, we're talking about consistent, long-term, strong dividend-paying companies. I'll show you a chart if you contact me at yourpersonalbank.com, and I'll show you which companies, what they've actually been paying. You'll immediately know who you want to work with. And again, many of these are name brand. You know them. They're A+ rated, and they're well positioned to keep going forward, doing this. The second step, we set up a bank line of credit. The cash in the policy is the collateral for the line. So this is a fully collateralized line of credit, super easy to qualify for. And the key is the interest rate they're charging for the loans is around 3 to 3.95%. If you're getting credited around 6 and you're getting charged around 3 and you access the funds, what's your money still doing? It's still growing. You're keeping the difference, and that's called positive arbitrage. And the last piece to fully understand this, I say this all the time to people. When you access funds from this account, from your bank line of credit, are you taking money from the bank or are you taking it from the insurance company? And the answer is the bank. Therefore, the money that was put in the insurance company is still earning interest, still getting credited, still growing, right? You keep the difference when you remember it's on money you spent. Where else can you make money? Interest on money you spent, and you continue that interest, that positive arbitrage, that earning every year for the rest of your life. That's your personal bank. That's how it works. If someone tries to make it more complicated, well, guess what? You know otherwise now, and you can say, no, I do understand how it works. It's really that simple. Now, there's a lot of uses for it. The most common, as I stated earlier, paying off debt. You can pay off debt faster, by the way. You can accelerate your debt payoff. Purchasing items. You can reduce the cost of purchasing items. You can reduce finance costs of purchasing items. You can also you lost opportunity costs for paying cash for items. You can get some of that back. So if you don't understand what that is, that's another subject for another day. In fact, if you go to yourpersonalbank.com, you'll see me talk on our website. There's shows and webcasts, podcasts that I've done talking about lost opportunity costs, for example, or compound interest or any of these other financial principles, well, that frankly most people, sadly, are not that familiar with. So we talk about that a lot. There's over a year's worth of shows with all the topics. I encourage you, again, go to yourpersonalbank.com for more information on those. And we'll continue to talk about this on future shows as we go forward. The last one is you can increase the rate of return on your investments. You can take money or assets or whatever. You can take money and invest in an asset and get a return. Or you can put it through the personal bank, pick up the positive arbitrage plus the return. In other words, do you want to make 7%, for example, on your investment, or do you want to make 9 or 10 on the same investment? That's what your personal bank can do. And if you add that up over time and you understand compound interest in a decade or 2 or 3, that can be, the difference can be massive. Okay? Now, one of the things, the problems we run into all the time is people sometimes get hung up on the fact that we're using insurance as a part of the financial tool to make this all go. Now, remember, this is not the type of policy most people are familiar with. Most people focus on what insurance is a death benefit protection for heirs tool only. It can be that, but it can be done. There's so many other things that can be done. And I always ask people real simple, when they start asking me on workshops or various things, when they start asking me death benefit related questions, I respond with a question back, and I'll say, let me ask you this. Are you looking to maximize death benefit protection, or are you looking to maximize growth, cash growth? Now, the answer in most cases for folks I'm talking to is, well, they want to maximize cash growth. And I'll say, well, then why are you asking me death benefit related questions? Because we're doing everything we can to minimize the death benefit. If you think of a teeter-totter, right, we're minimizing the death benefit and maximizing the cash, okay? By the way, by minimizing the death benefit, we just minimize the cost of insurance and fees and everything. It's another one of the big questions I get is, well, what's the cost of insurance? Well, it's a lot less than what you're familiar with or used to because we're minimizing it. We're doing everything we can to make it as low as possible. What that does is it makes it very competitive overall cost to other investment options that most people are familiar with. It becomes very competitive. And so it gets very eye-opening. Also, don't forget, this is the other one I get. I'm too old for this. Again, we're maximizing cash, not death benefit. We've successfully insured people and done this for folks up to age 79, just so you know. So you're probably not too old for this. And even if you are, we have options and still can make it work. What I'm going to do is stay tuned in the next segment. We're going to talk about this further and how all of this works.
For more information on Your Personal Bank, feel free to contact Ferenc at yourpersonalbank.com. Back to Your Personal Bank Show with Ferenc Toth.
All right, we're round and third. Welcome back to the Your Personal Bank Show. We're going to wrap this up today, but I'll tell you what. We've been talking about a lot of exciting stuff in terms of your personal bank, how it works, how it changes people's financial situations for the better. And like I said, by setting up the high cash value policy and using the bank line of credit to access the funds, we pick up the difference. We keep the positive arbitrage. We get to make 2 or 3% on money we spent. That's really, really cool. Now, again, some of the questions I get all the time is age, what if I don't qualify, health, things like that. And what's the cost of insurance? I touched on that in the last segment. Again, if you think of a teeter-totter, we're maximizing cash, we're minimizing death benefit, right? That's our goal. By minimizing the death benefit, we just minimize the cost of insurance, didn't we? So we just minimized reduced them. And by the way, we're setting these up where they're 50 to 90% cash day one, which means we're reducing the insurance by 50 to 90%. Now, the range is depending on how we set it up and the type of policy and what makes them best fit for you, okay? But if we're reducing it from 50 to 90%, that means we're reducing the costs 50 to 90%. Now, if you want to know a little other secret about why some insurance people, particularly licensed folks or advisors who do have an understanding of this, and like I stated earlier, most don't, but there is another reason, and then sadly it has to do with commissions. Why it's not recommended as often as, well, in my opinion, it should be. Well, if you're reducing, here's the thing. Do you think commissions are paid to an agent based on cash or death benefit? and it's pretty obvious, cash is cash, so it's got to be the death benefit, right? If we're reducing the cost of, this is a common thing I get, if we're reducing the total amount of insurance by 50 to 90%, we're also reducing the commission by 50 to 90%. So from a commission standpoint, there are advisors, sadly, that shy away or refrain for recommending it that do understand this for that reason. And it's sad, but it's true. And I'm just being real with you. I had a situation not too long ago with a client who was looking at this, and they brought this to their financial advisor, who wasn't that familiar with it, which I find is very common. As I stated earlier, unless somebody's dealing with bank boards, corporate finance boards, or family offices in terms of an advisor on a regular basis, this is not something they're probably dealing with on a regular basis. My point is, hey, if it's good for them, why not the average American? But anyway, they were saying, and the common objection came up, the cost of insurance is too high. And I explained to him, as I showed, in his case, we had put almost 90% of his money into cash and about 10% into the insurance. So we'd reduced the cost of insurance by literally almost 90%. And he understood that, and we went through the numbers, everything. He goes, "Wow, that's impressive. That's really cool." And then I made a statement. I said, "What do you think if you asked your financial advisor, to reduce his fees by 90%? How would he respond?" And he just laughed. He said, "That would never happen." I said, and my point was exactly. This is just a fact of life that, I run into on a regular basis. Now, the other thing we run into, quabbing questions or things that come up is, again, people start asking, well, I understand you're using an insurance tool. And again, they're not thinking in terms of the type of tool, how we're using it. Again, maximize cash, minimize death benefit, which is the opposite, completely the opposite of how most people view and use life insurance. Okay, so they start asking questions that are related to death benefit and things like that. Again, my question always comes back is, what is your focus? Are you wanting to maximize death benefit protection for your heirs? Or are you wanting to maximize cash growth? I mean, do you want positive arbitrage? How about reducing taxes? Do you think that might be a little important, especially going forward? What is going to happen with taxes going forward? A lot of people think they're going up. Does that make sense? That maybe you have some of your money in a situation where you can mitigate that, reduce your overall tax liability, both short and long term. Does that make any sense? Another reason I run into often is I want to reduce market risk. When we have guarantees, which we do with these type of policies, there's no market loss. In fact, we have options with the fixed option of guaranteed returns every single year. And a historical, around 6% dividends plus, last 25 plus years, and much longer than that even. So by reducing market risk, again, with uncertainty, potentially going forward, that can make a lot of sense, certainly for a portion of your monies. How about access for funds or emergencies, or for emergencies or opportunities? See, COVID, 2020, and all that taught, if it didn't teach us anything, one thing it taught the financial industry, and I had to laugh when I saw this, a lot of advisors were going around saying you needed 3, maybe 6 months of reserves, cash reserves. Well, the COVID shutdowns taught them a huge lesson that often that was not nearly enough for a lot of people. And now the common thing is you probably need 6 months, maybe a year of emergency funds. I've said for 20 plus years, you need 6 to 12 months of emergency funds. That's just wise, prudent financial planning. Okay. Now, the other part of that is, though, did anybody ever say you had to have the money sitting in a bank earning today next to no interest? I understand why you have the emergency funds, and it's smart you do so, but does it have to just sit there and languish and what we call dead dollars earning 0.0 something interest? The answer is no. The key to emergency funds is they need to be safe and they need to be liquid, right? Well, if you put them in the personal bank, I told you they're going to be 50 to 90% liquid day one. We have underlying guarantees. You're not going to lose. So it satisfies those requirements. What about opportunities? One of the most frustrating things that that exists is when you see an opportunity, when you're quite convinced, and particularly as an entrepreneur, I can say this, you're fairly well convinced or very convinced that this is a great opportunity that's going to move forward for you, but you don't have the financial wherewithal or access to the funds to take advantage of it at the time. Or maybe you have the funds, but they're tied up in in situations where annuities or IRAs or 401ks, where if you do take them out, you got penalties or you got taxes, or you got other things. You can't access those funds without getting hammered, right? Well, by having liquidity and use of your funds, not only that, and actually earn interest on it, the positive arbitrage, it frees you up to take advantage of those opportunities. And that's what I'm talking about. And the one thing about unprecedented uncertainties or a lot of uncertainty going forward is it's also going to present a lot of opportunities. I mean, there's a lot of folks talking to me today, asking me advice and questions. They know I've owned businesses. I've been in the financial industry for over this. This will be my third or fourth rodeo in terms of economic cycles. Okay, I've been over more than 2 decades. And they're thinking, well, I'm thinking about purchasing this or investing in that. What do you think? Should I do that? And a lot of the times, like people asking me a lot of those questions today, I'm saying, you might want to just kind of hold on and wait and see a bit. Give it a few quarters or give it a year and let's see what happens. Because when you're at or near all-time highs for asset values, it can't stay that way forever, can it? What goes up must come down. And if you're patient, you can wait for opportunities. And if you have money set aside, hey, here's the thing. If the money's sitting there and it's growing at 5-6% anyway, if you do nothing, tax-free, which is not bad, with guarantees, you don't have the impetus or you don't have to push that money into working for you because it's already working for you to a large degree. So, I tell this all the time. I talk about opportunities in this to people all the time. Oh my gosh, I'm on the radio do you think I get presented with financial opportunities? Just about every day, okay? And I'm actually one of the worst people to talk to about it because if I do nothing, okay, and our money's in a personal bank policy, we do nothing, we're making 5 or 6% tax-free. So got to be pretty well convinced it's going to do something better than that. And then you got to justify what's the risk and all those kinds of things, of course, to make it worthwhile. And let's be fair, folks, there's just not a lot of investments out there. There's some, don't get me wrong, but there's not a whole lot of them out there that'll produce, 8-10% returns or better consistently with some underlying guarantees. It just doesn't come about very often. You know what I'm trying to say. So I'm not saying there's no opportunity, but when there is, you want to be able to take advantage of it. What about long-term care? See, that's one of those things that most people don't, frankly, financially don't prepare for. It's the number one risk for retirees in terms of financial risk. And it's really expensive to pay for to try to protect yourself from it. Because the problem is long-term care insurance, typically over time, the cost of it increases. And I've seen this happen so often for so many people, clients of mine who have had, I didn't do it for them, but they had long-term care insurance, paid for it sometimes for decades when they were younger, and now they're getting into their ages, like in their 60s, 70s, and even 80s, and the costs had continued to increase to the point they couldn't afford to maintain it. And they were faced with a choice, either reduce benefits or let it go altogether. And unfortunately, that's the time frame when they would most likely need the benefit. So the problem is all that money got thrown down the tube, didn't it? Well, guess what? With these personal bank policies, even though, yes, we are reducing the death benefit intentionally to maximize cash, there still is one. And by the way, a good chunk of that death benefit is available for what they call living benefits. It's for significant medical expenses or long-term care expenses or terminal and those kinds of things. So it's one of the best long-term plans for addressing long-term care expenses you can do because, as I state all the time, if you need it, you got it. But if you don't, you didn't pay any extra for it because it's built into these. So what could be better than that? So that's my point. You can see whether your focus is death benefit protection or cash growth, you want positive arbitrage. In other words, you want to earn interest on money you spend. You want to reduce your taxes or reduce market risk. You want to have access to funds for emergencies or opportunities, or you want to address long-term care expenses. We have this tool, this Your Personal Bank tool, can address and accommodate all of those things. Now, the last problem I want to touch on today is many financial experts, advisors, will say, well, you don't want to invest in life insurance because it's a bad investment. And the problem is they were reviewing policies that were either never designed to be a financial vehicle or happen to be a hybrid. And what they're doing is they're saying it's a bad investment without realizing the policy's purpose. In other words, policies are often developed by insurance agents to address one or more purposes. Maybe cash value strictly is your growth, is your focus, but maybe you need some death benefit protection or some of these other things you want to address. And if it's criticized by media or advisors through strictly a growth potential viewpoint, they're missing the whole point. So, again, if somebody says this or that is bad, understand if they make these blanket statements, they're not addressing your situation. It often exposes their own personal bias, and many times this advice just doesn't apply to you. The advice should be based on your wants and your needs, not their personal bias. And that's why I strongly encourage folks to contact me at yourpersonalbank.com. Ask questions. Get more information. If you have a question you want me to answer on the air, I'll be happy to do so. Again, if you go to the website, yourpersonalbank.com, you can listen or watch any of the previously recorded radio shows we've done. There's over a year's, almost 2 years worth of content there. And their topics and all these different things that we've discussed over the years about how this works, answering questions for folks, and everything else. But as always, I look forward to talking to you again in the future. We're going to go through this together, and I just want to sign off. As long as it's still on our money, I just want to say, in God we trust.
Listen Tuesday at noon and Thursdays at 1 for more information on Your Personal Bank. Contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.